Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me at the market site in Times Square, New York City, we have Brian Joyce. He is the managing director on Nasdaq's market intelligence desk to give us an update on technical levels to watch in the Nasdaq 100. And Brian, I think before we even get to the charts on the Nasdaq 100, we really have to talk about the action that we've seen over the past week following the inflation data, because the movement in the Nasdaq 100 is really predicated on the other asset classes that have been impacted by inflation data.
Yeah, everything's correlated to some degree. The correlations can change. This year, the trend has been, value over growth. And the Nasdaq 100, along with all the other major barometers in the U.S. equity markets and globally, the stocks have been down. What we've seen over the last week is, a counter trend move where growth's been outperforming really since the CPI data came out last Thursday before the markets opened. And so we've seen some nice outperformance by the Nasdaq 100, the composite, the broader the growth index. And so what has accompanied that as well is significant price moves in other asset classes, particularly interest rates and the U.S. dollar index.
And let's take a look at those, because I think what's significant about these is the rate at which they moved. It's not typical to see this kind of velocity in asset classes such as this.
Right. So we've seen that all year long, like some just wicked big percentage moves. We haven't seen these kinds of moves in X amount of years. And last week was a short-term example of that. So the U.S. dollar index was down 4.1%. It was the fourth biggest weekly decline on record. Last time we saw this was March of 20 during that dramatic volatility, and before that was 1985.
Oh, let's take a look at some levels.
So right here we're looking at the dollar index DXY. We can see it's pulled back to the August lows, which is right in line with the highs made earlier in June, July. And so that right there is a potential for support. But if you look longer term back there, we could see that the prior significant highs were made down at the 103 and the 101 level. So right now we're around 106, 107 on the DXY. I think you could potentially see this dollar index pull back further. And then regarding interest rates, the 10-year Treasury yield last Thursday declined 28 basis points. That was also an historic daily move for that index. It broke prior support down at the 390 level. That range, that double top range that we could see it breaking down below, was about 35 basis points. So that that projects a minimum measured move down towards about 3.55%, which is right in line with the lows that we saw in October, late September. But if we look at a little bit longer term setup, we could see there's actually much bigger support down at that 3.25 level. So near term, we could say that maybe the pullback of the last week has been overdone, and the trend is to the upside for rates of the dollar. But if you look at the longer term move and how much both of those asset classes has moved over the last year to 2 years, you could see that a pullback in the near term over the intermediate term could be longer lasting, which I think would be a positive for risk assets.
And it should be good for stocks, right? Especially with the lower dollar, because that really was the concern, was currency on the balance sheets, right? For the third quarter, and we saw that play out a bit here. But I guess really what the question is this a bear market rally, or is this the beginning of a longer term bull trend? And that's what everyone's trying to figure out here.
Yeah, and so on the data front, along with the lower than expected inflationary numbers, CPI, PPI, we're certainly not out of the woods in that area, but we did have retail sales yesterday come out, and that was better than expected as well. So I think, as far as the economy goes, fourth quarter GDP, the Atlanta Fed GDP Now model came in much higher. As of yesterday's retail sales number is around, I think, 4.8%, whereas a couple weeks ago it was only, say, 4%. So the economic data for this quarter still is, certainly nothing that we would see in a recession. How that translates into, 2023 remains to be seen. We do have a yield curve that is deeply inverted, whether you're looking at 10s, 2s, or 10s in 3 months.
I mean, the consumer's been quite strong. It really has been a bright spot in the economy. And we saw it with Walmart's numbers, even though they have to, they have the pricing power there, of course, but it really didn't impact consumer demand, as an example. But again, as we saw, and we'll talk about more this on Monday with Chris, but retail's always going to be a tale of the have and the have-nots. Some are going to outperform, and it's got to come from somewhere else within the sector. But saving that for Monday, let's take a look at the Nasdaq 100 for some fresh technical levels to watch.
Yeah, so this here's a long-term monthly setup here, but you could see, so we've had a dramatic pullback this year, and we bottomed in October, but it bottomed right on this rising trend line that goes back 12 years to 2010, which has been tested on numerous occasions over that 12-year span. So, that's something, to keep an eye on, and let's say maybe let's not get too bearish at this time. If we want to look at some really near-term price action, we could see that we peaked just last week, or let's say on Monday, at a prior low that was made in September. So prior support now is resistance. We're seeing a brief pullback the last 2 sessions, but we gapped down today on the open 1.5%. That was the low of the session. We've been trying to claw back since. We're still trading above the 20-day moving average, and then just below there, we do have that price gap from last Thursday down at the 11,012. 11,235. So near term, that's the support level I want to see hold that price gap. If things do get a little weaker over the next week or so, that's a key level. I think you want to see this index hold, for the this hope for a year-end Santa Claus rally to continue.
Yeah, I mean, it seems again everything's just going back to the Fed, right? It's really going to be predicated on that. We're kind of coming out of earnings season. Really, it's just consumer spend trends over the next 6-7 weeks that we're going to have to watch.
Yeah, and so the last time we had a Fed meeting, they did say that they expect to raise rates only 50 basis points after 4 meetings of 75 basis points, but they do also plan that the terminal rate, where the Fed funds rate will peak next year, will be higher and stay up there for longer. So net, slightly more hawkish kind of meeting. But if they can, if the market feels that maybe the Fed is nearing that peak in rate hikes, maybe the market will be somewhat more comfortable than that, given the prior dramatic move. We started the year expecting only 3 basis points, or 3 25 basis point hikes, and we've already had on the equivalent of, let's say, 15 to 17 of that already.
Yeah, well, our wish list for 2023 is a new narrative to talk about in the markets, that's for sure. Brian, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.